Right, a very warm welcome to everybody listening in and watching the interim results presentation from the management of Matchtech. We're delighted to be joined by Adrian Gunn, the CEO, and Tony Dyer, the CFO. For those of you who have not used this process before, you will see in the top right of your screen an arrow that opens up the facility to send in your questions by email. You can do that right from the commencement of the presentation, and we will then go through as many questions as we can at the end of the presentation. But I'm now delighted to pass you over to Adrian Gunn.
Well, good afternoon. If we can start on page 2. So our interim results, these are the highlights. Last October we set ourselves 3 measures. The first was to improve our average contract margin percentage. The second was to improve the number of perm placements, and finally the third was to improve our conversion ratio. So it's pleasing to see that we've progressed our average contract margin to 7.4%. The number of perm placements has increased by 26%, and our conversion ratio now has tipped over into the 30%. So really good performance on the 3 strategic goals that we set ourselves at the beginning of the year. I'll now hand you over to Tony, who's going to run through the numbers, and then I will then run through the operational performance of the business and the outlook.
Okay, so if you turn to page 4 of the presentation, a pleasing set of results for us. We split our results here into the reported figures and then also the underlying figures, which excludes the Provanis acquisition, which we made in September 2013. So on the reported figures, very pleasing increase in NFI of 19%, increase in EBITA of 53%, and profit before tax of 43%. But on an underlying basis, so the existing core business, NFI up 15%, EBITA up 32%, and profit before tax 29%. Very strong first half performance. We have previously talked about our investments. In October we talked about investing this year in £1 million in our IT systems. That investment is going to be second half weighted, and in the second half of this year we're also going to be investing in additional headcount ahead of the to support the recovery as it goes forward. So our profits historically have been over the last couple of years have been 40% first half, 60% second half. This year it's going to be closer to more even split between the first and second half. So we have got investments going in the second half of the year. If you turn to page 5, which is the earnings per share and dividend, again we've split this into reported and underlying. On the underlying figures we've excluded the million shares that we placed in September to fund the acquisition of Provanis. So on a basic EPS is up 43% and 31% on an underlying basis. We have progressed our interim dividend. We've increased it by 5%. We've always stated our dividend policy is a progressive dividend policy with a cover of 2 times over the cycle. We've had a few years where we've been under the 2 through the recession. This year we expect our dividend cover to return to 2 times, and obviously we can progress that dividend going forwards. If you move on to the balance sheet, it's a very strong balance sheet. Key factor this year or this period is we're largely affected by the day of the week that the period ends on, because we pay all our contractors on a Friday, and 31st of January this year finished on a Friday. So we have quite a large outflow of cash and a net cash outflow this period of 7 million on the last day of the period. So net debt we would normally have expected to have fallen in the first half of the year and then have a cash outflow in the second half of the year. Because of that timing effect of that day of the week, net debt has remained fairly stable in the first half, but we would expect that to fall in the second half of the year. We've had a very pleasing period in terms of debtor days. They've reduced from 48 to 42. Around two-thirds of that is better credit control, reducing the overdue debt from our clients, and about a third of that reduction in days comes from a change of mix of business. So a bit less business from clients with longer payment terms, and a bit more with obviously placing people at clients with shorter payment terms. And if you move on to page 7, the cash flow reflects that situation with the Friday period end. And as you can see, there's a 6.7 million fall in trade debtors because of the credit control improvements, but also a 7 million fall in creditors because of the timing effect of the period end day. And cash conversion is slightly down because of that. On the next slide, we've got a bit of historical performance figures, and the next two slides. The first one is contract activity. So this shows the numbers of contracts we have on assignment at the end of each half year. And as you can see on the right-hand side, we've actually maintained the number of contractors on assignment at 7,000. This is despite a loss of 300 contractors at Portsmouth Naval Base when they closed shipbuilding at Portsmouth, and 100 obviously extra contractors have come from Provanis. The figures at the bottom of the dark green bars are our average contract margins, and as Adrian said, we have improved our contract margin percentage, and that's moved from 6.8 to 7.2%. Pre-recession we were at 9.8%, and we've got a medium-term target of getting those margins back up to pre-recessionary levels. So over the next few years that is going to be a key focus for us. And then on slide 9, this is the permanent side of the business, and as Adrian said, the volume of permanent placements is increasing. We have a particularly strong period and performance from our Alderwood brand, which is our skills and employability brand, which is a lot of higher volume recruitment but lower average fee. So the figures at the bottom of the green bars again are the average placement fee. They have been largely skewed by the Alderwood brand, which has grown its NFI by 81% in the first half. Going forwards, although the permanent market is in a recovery period, we don't expect to see this a step change in permanent. It's going to be a slower, shallower growth period. But as I say, we are investing in our headcount to take advantage of that recovering market as we go forward. And then on page 10, this is just a summary of our 10-year performance, and it shows how we've performed through the recessionary period. We believe we've got a resilient business. Yes, we were affected by the recession, and the three key factors for us in terms of the figures going forward: increase in our contract margins, increase in the number of permanent placement as the market recovers, and increasing our net fee income conversion. You'll see historically we've peaked at 40% on the conversion ratio. We're slightly differently structured business now, but we have a mid-term target of getting that to 35%. So I'll pass you over to Adrian, who'll go through the business review.
Yep. So this is really the sort of science behind the numbers. But before I dive into the business, I thought I'd just set the scene with the recruitment market as we're seeing, particularly in the UK. I think there's general agreement that the UK recruitment market is very much in a recovery mode. The latest REC report on jobs indicates that 79% of employers are looking to recruit in the next 12 months, obviously, which is good news for us. What we're also seeing in the industry that there's really two types of staffers. You've got the generalists and you've got the specialists. Obviously, your generalists are your guys like the staff lines, who is high volume transactional business, where you then got the specialists where Matchtech sit, which is the lower volume, higher margin, more difficult to fill recruitment areas. And that's obviously where our heritage is. We're actually 30 years old in August, So we're going to continue with our sector approach into niche markets. Our biggest challenge is really working with organisations and selecting organisations that really are willing to pay a premium price for the quality service that we operate. So that's a challenge for me internally. And when we move on to internally, if we go to page 13, you'll see the operating structure. Now, Matchtech Group's split into two business units, engineering, which is 60% of our NFI, and professional services, which was set up 3.5 years ago, is now 40% of our NFI. Our largest client now only represents 4.5% of our NFI. So we're not over-reliant on one particular client. And if you go a little bit further, our top 20 clients represents 32% of our NFI. The only change to the structure we've made this year is the inclusion of Provanis on the technology side of the business. And whilst we're on Provanis, I'll just give you a quick update. The integration's gone well. We've moved the team from Twickenham to our London office. We haven't lost any of the existing sales team. We've actually added headcount, sales headcount to that team. Contractor numbers are growing. We've recently extended the framework agreement with their largest client, which was a company called Stryker. Group headcount currently stands at, at the end of the period, stood at 413. And as Tony mentioned, we're actually putting headcount investment in place. It currently stands at 423, and we hope by the end of July that figure's up to about 450. But this headcount investment will be very much in our existing areas of the business. So this is within sectors that are hot. It's going to be within sectors that are established. It's going to be about increasing scale with those existing teams. So what we're hoping is that the time that those new consultants become fee generating is accelerated because we're putting them in very warm areas of the business where they've got warm clients and warm candidates, and it's a case of just transacting that business. If you turn the page, you can then see the engineering sector and how it's structured, very contract focused, and really engineering recruitment now, there's been a real step change. It's contract recruitment now is now the chosen method of recruitment within this sector. You know, the client likes contract recruitment because they can manage their workforce and their fixed headcount costs, and the candidate is also keen to work on a contractual basis. They're normally paid 33% more than their permanent counterpart. They can operate through a tax-efficient vehicle, and if they want to take a month off to watch the World Cup next month, they can do so without damaging their career. So that flexible lifestyle is very appealing to the engineering workforce community. Whilst we're on engineering, infrastructure continues to be the largest and fastest growing of the sectors in which we operate, and with government funding on highways, rail infrastructure and utility upgrades, we expect that to continue. Energy and automotive have shown steady growth. The most pleasing is even with the closure of shipbuilding at Portsmouth, we still managed to grow our marine recruitment. The only sector that's in decline is aerospace. At the moment, a lot of the work in aerospace is in manufacturing on commercial aircraft. Our history has primarily been in design, stress engineering, and what we're hoping is that these programs, or R&D programs, will come into play in H2, so we hope to see that trend reverse in the second part of the year. If you then move to slide 15, which is the numbers within engineering, you can see that contract margins up, perm fees up, which has generated 5 million of profit from operations, which is an increase of 25%. The average contract margin now stands at 7.3%, but more importantly, the average NFI per head is an impressive 175,000, which has resulted in a conversion ratio of 37.6%. If you turn to page 16, you can see that engineering finished the period with 5,300 contractors on assignment, even after losing 300 at Portsmouth. And as I said earlier, engineering is very contract focused, but we still managed to make 500 placements within this sector. And we believe this is a key growth area for us going forward. You can also see we've invoiced 940 clients, so as well as the long-standing relationships we got with the likes of BAE, Babcock, Transport for London. We've also got some great high growth SMEs that we work with that go unreported. What's also worth noting is one of our largest client wins last year was UK Power Networks, and they're now one of the largest clients in engineering, and they're the 5th largest client within the group. So that acquisition's gone very well. From an international perspective, our low-risk international strategy of following our key clients overseas has taken us into new territories, and as you can see, we're now operating in 33 different countries. Unfortunately, one country that continues to remain challenging is Germany. Germany is our only overseas office, and we're currently reviewing the logic of that strategy at the moment. Now, the next two slides, so slide 17 and slide 18, are the individual growth drivers behind each of the sectors. And I wasn't proposing to go through each of these, but if you do have any specific questions about any of those sectors, if you could email those questions in and we'll capture those at the end of the session. So if you then turn to page 19, you can see professional services, and also you can see it's a very different business mix from engineering with a very much higher permanent focus. On the contracting side, technology is the largest part of that with the Connectus and Provanis brands, whereas Barclay Mead and Alderwood are very perm-focused brands and are driven by growth in the UK recruitment market. So I suppose if you were to look at Matchtech Group now and to simplify its investment strategy, you can say that the engineering skill shortage is creating contract demand for our engineering business unit, and a UK recovering market is creating permanent recruitment for professional services. So we believe we've got a really good balance now between engineering and professional services, and a really good balance between permanent and contract recruitment, which I think is a real differentiator between us and a number of our competitors. If you then turn the page to page 20, this is the numbers behind professional services, and again you can see contract margins up, perm fees are up, and you can see that we've generated 1.2 million of profit from operations, which is growth of 50%. Again, if you look at the KPIs, the average contract margin in professional services has remained flat, which is a little bit disappointing. Separating Connectus from some of the old Matchtech legacy framework agreements has been a little bit challenging. We've got some more work to do on that. The number of perm placements in professional services is up 35%, and you can also see that the NFI per head is up 10% to 128k. Now, obviously, that's quite substantially lower than what we're achieving in engineering, and that's down to the structure of the business unit. But we are setting ourselves a goal to get that figure up into the 130, 140k per head. So when we're talking about our headcount investment on sales consultants, the majority of that will be in engineering. In professional services, we can still grow profits through efficiencies, primarily around increasing the NFI per head. But the conversion ratio stands at 15% in professional services, and our mid-term goal is to get that to 20. If you then go to slide 21, which is an overview of our technology brands, Connectus and Provanis, you can see the markets in which we focus: ERP, big data, comms and infrastructure, software, and controls and automation. We have 1,350 contractors in the technology space, and we've placed over 300 permanent candidates. Our client base is 440 clients, a mixture of corporates and SMEs. Our largest client in technology is Exchanging, where we've recently had our framework agreement extended for a further 2 years. We're also working heavily with Selex, who are part of the Finmeccanica group, and Inventis on their control systems arm, and also I mentioned Stryker, who are Provanis' largest client. On Barclay Mead, which is slide 22, this business focuses on 4 niche areas of finance, HR, procurement and marketing and sales. And again, we've made over 280 placements and have 250 contractors on assignment. Now, Barclay Mead is split between 2 offices, London and Whiteley and Fareham, which is in Hampshire. The London operation focuses on the retail, energy and technology sectors, and our Hampshire office, unsurprisingly, focuses on engineering, where we can work closely with Matchtech to get our cross-selling opportunities. If you then go to the final slide on the brands, you've got Alderwood, which is slide 23. And as Tony mentioned earlier, Alderwood's had a very strong performance with NFI growth of 81%. And that's very much off the back of the work we did last year. Last year we secured the exclusive contracts with HIT Training, Learn Direct, and Lifetime. And we've made in Alderwood, and 60% of those placements are with those 3 clients. So looking forward, our strategic goal has to be in H2 to secure 1 or 2 more of those framework agreements. And if we can achieve that, then growth will continue. Because within Alderwood, this area is hot because of the change in government funding for vocational training. And we believe vocational training here is to stay. Yes, the funding for Alderwood ultimately comes from government, but I think there's cross-party support to continue to grow vocational training for our children. So I don't see our business being affected by any potential change in government coming forward. Which then takes us finally onto the outlook slide. And to be honest, the outlook's not a lot different than it was last October. You know, the key challenge is to continue to grow our contract NFI, and that will be generated through the skill shortage. We still see that, to continue. We will continue focusing on improving our contract margin by working with clients who are willing to pay a premium for our service. We will continue to grow our perm fees as the UK market recovers, and we will continue to ensure our conversion ratio stays above 30%. Tony mentioned about investment. You know, we're investing in our business systems to make sure we've got the right foundations in place for growth, and we're investing in headcount because we're in a period where the UK recruitment market is growing very quickly, and we want to capitalise on that. Our new chairman, Brian Wilkinson, started in December. Brian's settling in well. His wealth of expertise is helping us shape the business, helping us understand what parts of our business processes need changing, improving, and has really given us the support to take the business forward to the next level. So all in all, we're in pretty good shape. I think we've had a really good H1, and it's given us a really good springboard to make sure we have a solid 2014. So I'll take any questions.
Right, thank you very much, gentlemen. We already have a number of questions. Just to remind the audience to please put them through via email. Right, let's kick off. Tony would like to know how you regard the UK government's support for training and indeed the recent budget, whether it has been helpful, and indeed whether you regard help as being good or bad for your business in the medium term as you benefit from undersupply of skilled engineers and technicians.
Lots of questions in one there, Andy. Government support, what is positive is, I think, if we take the vocational training side of things, so the apprenticeship programs, I think you'll find now that there's, as I say, cross-party support for that. And the funding for apprenticeship programs, I think, here for the long term. So I think our Alderwood brand will continue to grow off the back of that. With regards to government support for funding on infrastructure, obviously that's very welcome. I think there's more that hopefully will come from that. You know, what used to happen is that government would change from investing in highways and move the money into railways and move the money into utilities. What I think is clear now is that government understand that all 3 areas of infrastructure need heavy investment, which I think is good for the UK economy. One area where I think the government can help us is on immigration. You know, there is a skill shortage. We do have a lot of good initiatives in play to help improve the quality of what we're teaching we're giving to our children, but that's not going to hit the labour market for another 5 to 10 years. So we've got a window where we're going to need additional support, and the only way that additional support is going to come from outside of these shores. So I think a more grown-up debate about how we're going to get those skill types into this country needs to be had, but that's not for me to come up with a solution. That was just something I would like party to start debating, and I get the feeling that's starting to move.
Okay, thank you. We have a question from Paul, maybe for you, Tony. What would be your target operating profit margin at that point where the UK economy reaches normal levels, in inverted commas?
I mean, our operating margin in the period is 3%. Pre-recession we peaked at around about 5%. Now, that's what before the recession we were purely focused on engineering and purely a single site recruitment business. So our contract margins were higher and the perm market was very buoyant. So at that time our operational efficiency was excellent, and we converted our NFI into operating profit at a peak of 42%. Because of the structure of the business, I think we should be looking, 4 to 4.5% operating margins in the medium term. So that's really where I think we're targeting.
Thank you. And perhaps a related question from Jim. In your opinion, given that you've both got considerable amounts of experience in your chosen expertise and operating in the UK, where is the UK economy in the current cycle? Are we around a midpoint? Because the stock market has been effectively booming for 5 years. It is an early indicator. But do you think there is much more scope for economic recovery?
From a recruitment point of view, I think there is. We saw client confidence come back last year, but really on the permanent side of things, we only saw candidate confidence come back the tail end of 2013. So from a point of view, are we at the start of the recovery? From a recruitment point of view, I think we are. I think we're probably about 6 months in. So I think there's a long way to go yet. And that's why, if we're going back to talking about the investment in headcount we're making, we're putting that headcount investment into sectors that are hot, particularly things like infrastructure in the UK recruitment market, because that's where we're going to make our growth in profits, certainly in the short to medium term. So yeah, we just see this as the beginning rather than 2 or 3 years into it.
Thank you. Well, and again, following neatly on from that, John would like to know how you balance the investment that you are making in hot areas at the moment, which are very UK focused, with a longer term view of how you might spread your activities abroad and how you allocate your capital now, short versus medium term, as it were.
Yeah, we've been running with a low risk international strategy now for a couple of years by following key clients overseas, but transacting that business from the UK. Now, as I said, if you look on the engineering slide, that's taken us into 33 new territories. That we can continue to do that as well as invest in the UK. So our international strategy will be relatively reactive, because obviously following a key client is off the back of that relationship, and it will be slightly slower than going into a new territory and setting up an office. But we believe that we can invest in the UK, get the growth from that, and have a concurrent strategy that runs alongside that from an international perspective. So if and when the UK recruitment market normalises, we should have a more robust international strategy in place.
Thank you. A question from Paul about the permanent placement, and he says that prior to hearing your presentation, he might have thought that permanent is not a core part of your business, but you have made a convincing case for the balance between permanent and temporary being a differentiator. Approximately how many of your major group clients would expect you to offer both?
It's a difficult question. The word expect, from my perspective, as an ex-permanent recruitment consultant, I'm always going to say that perm recruitment is extremely important. As a business, we are looking to get a good balance between contract and perm. What we're trying to do is get 2/3 of our NFI generated from contract and 1/3 from perm. Now, our clients would transact with us just purely on a contractual basis, and likewise they would transact with us purely on a permanent basis. But The reason we like to do both with a client is that the permanent recruitment provides the stickiness to the relationship, which then protects your contract business. So to me, it's a fundamental BD tool, business development tool for us to be able to take on their more tactical contract recruitment and also provide a strategic perm recruitment function along with it. And if we do that successfully in both areas for a client, the client acquisition process is a lot easier and is a lot more robust.
Thank you. All right, just a reminder, we've got time for a couple more questions, so do please put them through if you want to. We already have some more here. Acquisitions and bolt-ons. You're obviously experienced in doing them. Provanis seems to have been a very good deal at this early stage. So Greg would like to know, are they becoming more difficult in terms of price expectations from vendors? And the corollary to that is if you can use Matchtech shares as part of the currency, are you finding that the very strong performance of Matchtech shares in the last year or two is proving attractive to vendors as well? From a
point of view of our M&A strategy, it is very much looking at small contract-focused opportunities within the engineering and technology sector that we can bolt on to our existing platform. So the Provanis deal fitted that perfectly. I'd love to say that I've got a huge pipeline of those opportunities all lined up. I don't. They tend to come across your desk on a ad hoc basis, and really the secret behind it is getting to know the individual and understanding the individual who runs that business and what their motivators are for wanting to sell it. If the motivators aren't right, it normally means the pricing's not going to be right. So some of these deals do take a long time because it's about developing a very strong relationship with that individual and almost not convincing them, but making them aware that we're going to take that precious business that they've developed and nurture it and grow it. And if we can get that across to the founder of that business, that goes a long way and actually counts towards the total the price that you'll pay. So we're going to continue with that strategy, and I would hope if we could transact one of those deals a year, that would be fantastic.
Okay, thank you. And maybe just the last question from Sue. You mentioned that you have a new chairman with considerable experience. Has that yet translated into any change in the company's strategy?
No, as I touched on earlier, our strategy is to continue as a specialist recruiter. I think that's in our blood, it's in our DNA, and certainly our chairman is very much in line with that. The changes where Brian is helping us is when Tony was talking about investment in business processes, so investment in technology, whether that's our back office, whether that's our CRM, but also is looking at our business to make sure it's fit for purpose, not just for today, but moving it forward, and it marries up to our growth expectations. And that's really where Brian has come in and helped us. You know, I've been with the organisation for 25 years. Tony's been with the business 18 years. So we you know, that's great. It's a real strength, but it can also be a little bit insular. So having a external third party with a wealth of experience, that helps to complement the executive team. So I think we've got a good balance now. I think we're playing to all of our strengths, which is making the team a lot stronger. And I think we know what we need to achieve to move forward.
Great. Well, Tony, Adrian, thank you very much. Best wishes indeed for going forward, and thank you all for attending as well too.
Thank you very much.
Thank you.